Bianca, we are ready to go.
Confirmed on the screen.
What? And welcome to our weekly webinar. I am sorry for the technical difficulties, but here we go. We're going to get talking about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for your investment strategy and financial goals. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I am joined on the call by my partner and colleague, Paul Tepsich, the founder of High Rock, and our financial planner, Bianca Tomlinson. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask questions. Remember, if you have a question, it's likely that other listeners may have the same question, so please definitely feel free to engage us. Now, based on some excellent feedback from our listeners, we've made some adjustments to the format of our weekly call. So if you're a first-time listener and would like to get a little bit more information about our private client services, we have a separate webinar that will provide you with this on our website just adjacent to this weekly webinar. Well, each week we discuss our key themes for 2015 and any new and relevant news that we believe to be pertinent in light of those themes. So our overall and number one theme is to expect the unexpected. And this year so far, there have been plenty of surprises. So let's get back to this one. At the beginning of the year, many experts expected the Fed to start raising rates sometime in 2015. At first, the focus was on June as the timeline, but weaker than expected, the first quarter growth pushed that out to September. So once again, what was expected clearly did not happen. What was a relatively optimistic U.S. Fed outlook earlier in the year is now a more concerned outlook, specifically indicating that, and I quote, recent global economic and financial developments may restrain economic activity somewhat and are likely to put further downward pressure on inflation in the near term. So now expectations have shifted. And the concern being expressed is the lack of inflation. And for all central banks, price stability is their core mandate. Now, most have a target of 2% for core inflation. So let's have a look. In the U.S., core inflation is definitely stagnant, but well below the Fed's target. More importantly, expectations of improving inflation are no longer as optimistic. Inflation in the euro area had started to improve, but suffered a setback in August. A similar situation in the UK, back down to a 1% level, so well below their targets as well. In Canada, a weaker Canadian dollar had contributed to increasing levels of inflation. However, August showed a pretty steep decline. In Japan, inflation is close to 0%. August data will be released on Thursday and will be watched closely. Well, last week we pointed out that despite the hope that employment growth would give the consumer more spending power, this too may be overly optimistic. For the U.S. consumer, who is responsible for 2/3 of the economy, employment growth is slowing. The labor force participation rate remains at levels not seen since the late 1970s and early 1980s, and wages are not increasing. As well, the manufacturing sector is struggling. And last week, before the Fed's interest rate decision was announced, we also talked about the increase in global debt. Since 2007, we've seen significant increases in global debt, and especially in developing economies, particularly China, Hong Kong, and Singapore. So when interest rates go higher, servicing all of this debt will become problematic, and certainly this has become a factor that is influencing the Fed's decision on whether or not to raise interest rates and when. In Canada, the big story is that Canadian household debt to income levels are at a record. Well, this is okay as long as asset prices are rising and debt to total asset levels are falling. However, if asset price growth begins to stall or decline, or if the cost of carrying debt should grow, or worse, a combination of the two, then it becomes a serious problem. But it's not just what the U.S. Federal Reserve does. Credit conditions have already been tightening. Lenders are demanding more security. Borrowing is becoming more expensive. So if the Fed were to raise rates, borrowers will be hit even harder. Now this, in and of itself, will automatically put the already struggling global economic growth into greater headwinds. And this is also an issue to be considered. But we concluded that while the Fed is anxious to begin interest rate normalization because rates have been at their lows for close to 7 years, the global economic situation may preclude them from doing so. And we were correct. Central bankers don't like volatility because it creates uncertainty and erodes confidence. Consumers put off purchases, demand declines, producers cut back, economies slow, and prices decline. Inflation slows. So volatility is now at levels that we haven't seen since 2011, and in a few weeks ago we actually hit levels that we hadn't seen, temporarily hit levels that we hadn't seen since the financial crisis. Bond markets signal inflation expectations because bond investors want to make sure that they are getting returns better than future inflation. Other financial markets take their cues from bond markets. So bond markets continue to tell us that inflation expectations are low because the prospects for economic growth are low, and in the case of some German short-term bonds, there is real concern about deflation, which has driven safe government bonds into negative yields. Now, they also tell us that, at least for the time being, interest rates are not going higher. So low interest rates and low returns on bond investments have forced investors to take greater risk in search of better returns and have driven equity markets to new highs. Well, we've been quite vocal since last April with our opinion that stocks were expensive. The S&P 500 prices were driven to record highs in May of this year. And at High Rock, we've been telling our clients and anybody else who would listen that this was overdone. Now, since their highs, they are down by about 9%. And fundamentally, they are still expensive by historical standards. But we would not be surprised to see the S&P 500 fall by up to 20% from its highs. So basically another 10 or 11%. The 10-year average price to earnings ratio is 14.1. Currently, the 12-month forward average is 15.6, so still relatively high to its average. Now, among other data, this tells us that stocks are still expensive. In fact, earnings for the second quarter declined, and it is expected that earnings for the third quarter will also decline by approximately 4%, which would be the first back-to-back quarterly earnings decline since 2009. That has to be something that concerns investors. As I said, other data agree with our assessment. Enterprise valuations and earnings still show stocks to be expensive. Now, as portfolio managers, and I've talked about this regularly in the last few webinars, but we have to have a long-term perspective. Now, we believe that markets are cyclical, that we're definitely off the recent cyclical highs for equity markets. Now, it's not exactly clear how far into the cyclical downturn we've moved, so we're watching closely as to how markets are behaving. Now, it's not necessarily about the economy, but about the perception of what is to come next. That's where our understanding of behavioral finance enters the equation. We need to determine the current psychology of the market and look for the buying opportunities when they present themselves. Now, I know I say this every week, but with low economic growth, low earnings, low commodity prices, low inflation, and low interest rates, we're going to continue to be in a low return environment, and investors will need to continue to adjust their expectations to this situation for at least the foreseeable future. As always, we need to stay focused on the risk-adjusted returns and not be driven to chase higher returns at the expense of adding risk to our clients' portfolios. So we had a request this week to talk in a little bit more detail about the composition of our portfolio models. Now, we have 3 models with which to build a balanced portfolio. Our fixed income model is comprised of 4 sub-asset classes. AAA government bonds are the safest asset that we'll own. They are a hedge against deflation and temporarily are able to offset any short-term spikes of equity market volatility. High-quality corporate investment-grade bonds also protect against deflation and add yield to the average bond return. Now, we often talk on this call about the bonds, about the excellent risk-adjusted returns of high-yield bonds that are not correlated to interest rate movements like other bonds. We'd like that diversification and have a dedicated allocation to high-yield bonds. And finally, we like the tax efficiency of dividends, and we can get these from fixed-rate perpetual preferred shares. We only buy the best quality financial institutions and avoid the fixed reset preferred shares that have lower yields and much shorter maturity horizons. Now, we have 3 key concerns when assessing the risk inherent in our fixed income investments, and I've talked about these fairly regularly on the last number of calls. The first is interest rate risk, the future direction of interest rates and how they affect fixed income assets. And secondly, duration risk, where we need to assess which part of the yield curve will be most impacted and what the average maturity of the bonds that we own should be. In Canada, core inflation is running at a level of about 2.1%. So this leaves us to reluctant to buy bonds that yield less, which would give us a negative after inflation real return. Now, we bought 10-year bonds at better levels last May, and last week we actually added some 30-year bonds that yielded yielded 2.35% before they moved higher in price the next day. We actually added a value here of approximately 2% to our portfolios. So good purchasing, Paul. We've also had to be vigilant on the quality of the bonds that we own. This is known as the credit risk, and we have to ensure that the companies whose bonds we own are going to be able to make their interest payments and, of course, repay the principal. Now, this is crucial, and we spend lots of time these days monitoring this situation. With widening corporate bond spreads over the higher grade government bonds, we're looking for opportunities that may be developing here. In our global equity model, our objective is broad diversity across many different geographical locations and economic sectors. Our approximate target weights at the moment are 10% for large Canadian companies, 7% for an assortment of Canadian real estate investment trusts, 20% of large U.S. companies, 7% for mid-sized U.S. companies, and 5% for small U.S. companies. Now, we allocate 22% for large international, which is non-North American companies, 2% for small international companies, and about 6% for emerging market companies. The balance for future opportunities, future buying opportunities as they develop. We're holding that currently in cash. And as we've said regularly, because we think equity markets are expensive, we want to be a bit more defensive, and this is a way of being a bit more defensive and, of course, preparing ourselves for buying opportunities when they come. Now, remember, we buy companies and not countries through these exchange-traded funds that we invest in, and that the percentage weights also could change at any time if we see advantages in doing so. We'll also own some of these ETFs in U.S. dollars or have cash in U.S. dollars because when the world gets volatile, the U.S. dollar becomes a safe haven, and this can drive the value of the U.S. dollar higher, which reduces the impact of volatility on our portfolio. Our third model is made up of usually small to mid-sized Canadian companies that we believe through our in-depth research may have outstanding growth potential. This could hold up to 10 names and may in fact hold U.S. companies as well if we see the potential value of doing so. At the moment, we own about 3 companies in this model, so that just gives you an idea of how defensive we're being. Now, this is intended to be a tactical model so that when we see opportunities, we can be very quick and nimble into moving into them. But at the same time, if those opportunities dry up, if the companies do generally get more expensive and we feel that that's something that's run its course, then it gives us the ability to move out of these. Now, a client portfolio, depending on their goals, objectives, risk tolerance, and their wealth forecast, may strategically comprise all of or some of these models in varying degrees. Now, a typical 60% equity and 40% fixed income balanced portfolio might have a 40% fixed income weighting. It may have 55% of the global equity model, and it may have 5% of the Canadian growth model. However, it could, depending on the type of strategy, have perhaps a 45% global equity and a 15% Canadian growth equity. It's just a function of what we determine with our clients as to how much growth is needed in the portfolio. As well, more conservative balance might be called for. We could have 60% fixed income and only 40% equity, or even 70% fixed income. Again, depending on what a client's strategy needs to be based on their wealth forecast. Now, our research shows that over time, a well-balanced portfolio will give an investor better risk-adjusted returns than some of the equity indices, like the S&P 500 or the TSX. So, as I was saying, U.S. companies, they comprise approximately 18% of our client 60% equity, 40% fixed income portfolio. Well, the S&P this year is down close to 4.5%. Canadian companies in our global model are approximately 9% of the 60-40 mix. The S&P TSX is down less than 6% this year so far to date. Euro area companies represent about 4% of our 60-40 model, portfolio. Euro Stoxx 50 is up a little over 1% this year. Japanese companies are about 3% of our 60-40 portfolio. The Nikkei 225 is up by approximately 3.5% so far this year. UK companies are about 2.5% of our 60-40 portfolio. Year to date, the FTSE 100 is down a little under 7%. Australian companies represent less than 1% of our 60-40 portfolio. Year to date, the Australian All Ordinaries Index is down about 5.5%. Well, as for China and other emerging market companies, which represent about 3% of the 60-40 portfolio, well, China's Shanghai Composite is down 2.3% on the year. But in fact, the emerging markets ETF that we buy for our model is basically unchanged on the year. So that's definitely a good thing. So in comparison, now our sample 60-40 portfolio, which is comprised of our 3 models, is up just a little over 4% so far this year. Paul, did you have anything you want to add in here?
Well, you touched on it earlier, Scott. We actually were going to buy a name that I know very, very well today, but I backed away, and quite frankly, just a little bit worried about some of their exposure in Turkey, and think we can probably get it a bit cheaper. So certainly one stock that we backed away from and got a bit more defensive on our entry point. But other than that, we, as you said, we own about 3 or 4 names and monitoring them closely.
And again, that's just an example of what we mean by tactical, a tactical portfolio. So we try, and Paul tries very diligently to select appropriate price points with which to make purchases. And we actually talked about this last week, but I'll just bring it back up again. We sit down on a weekly basis to look at each of these price points. And quite honestly, if we determine interim before we sit down that we may need to make some adjustments, we will make these adjustments. But we're always have targeted price points that we determine represent good value for anything that we want to buy. So that cash that's sitting in client accounts means that we are still waiting for those price points to be realized, and we'll continue to monitor those on a regular basis and determine, given all the economic circumstances and what's going on in the world, as to what prices make sense. Okay, so that's it for today's discussion, but if anyone on the call might have a question, please feel free to ask now.
I have a question. So your global equity portfolio, right now you have 29% in international. Like if you, oh no, wait a minute, maybe not. 30%. Like if you talk about your large international, your small international, and your emerging markets. So given everything you hear about China right now and all that, will you be adjusting that or sticking with it?
No, and Paul, feel free to come in anytime. We, at the moment, have targeted that allocation because that's generally what we want to own. Now, from a strategic perspective, what we'll do is determine what price points we want to own that. So if a client, if a client has been with us for quite some time, they may have some cash that still needs to be allocated, but they may also have a position in emerging markets, for example. Now, interestingly, you bring up emerging markets in China, but the emerging markets ETF that we've been buying that includes a weighting in China actually hasn't really been hit very hard. So we're also strategically buying what we think are the right assets, the right ETFs, which mitigate a lot of the potential of what you're talking about, this Chinese situation.
Yeah. Okay.
Does that make sense?
Yes, it does.
Excellent. Paul, did you want to add anything?
No, that was a good explanation. Thank you.
Okay.
And one other question. So
absolutely.
Okay, so when you you first get a client and you decide on what the makeup should be for that client's portfolio, how often and why would you maybe change the portfolio? Does that make sense? Do you know what I'm asking?
Yeah, it could be two things, and I'll just cover them both, I think,
okay.
to create clarity. But if we determine, and we go through a fairly rigorous process to determine what a strategy should be, and so if that strategy, we come down and say, okay, we think your strategy should be 60% equity, and 5% of that should be growth equity, and 40% should be fixed income, then that's the strategy that we've structured, and we'll start to build, and we won't build it immediately all right away. We'll very gradually start to put it together, and it may take 6 months, it may even take a year, just depending on the prices of the assets that we want to get in there. Now, if we sit down and have a review 6 months down the road, as we will with all our clients, at least every 6 months, have a review of their wealth forecast and the subsequent portfolio strategy, and if we determine that based on what we've accomplished so far, we need to make adjustments to that strategy, we'll do that in conjunction with the client. So if the client strategy needs, or we feel, or the client feels they want to add a little bit more growth into that portfolio, so we adjust the equity to 50% global equity and 10% of the growth model, then that's something we do in a discussion in conjunction with the client's overall well forecast and strategic portfolio plan.
Okay. Okay, thank you.
Paul, did you?
Well, it's an ongoing process, and it is, I think, two things I would just add to expand on what you said, Scott. Every client is different, so their situations may change, and they may need to become more aggressive or more defensive. And the second thing is we do all this work, and you're seeing tip of the iceberg on these presentations every week, but we really do live, eat, and breathe, and sleep these markets and try to determine the best course of action to get the best risk-adjusted returns that we possibly can in all of our portfolios. And if we see the need to make changes, and that may be tweaking the portfolios here and there in various either various asset classes or geographies, we will do that as we see fit.
Thank you. Excellent. All right. Well, we've almost exhausted our time here, so thank you very much for the questions. It's great to get feedback as well. If any of the listeners on the recorded version have questions, we're more than happy to receive them from you. So please feel free, and feedback on the webinars. Also, we get great feedback, and it allows us to tailor the calls to what you, our listeners, are looking for. But that's it for another week, and I want to thank everybody for taking the time to tune in. Wishing you all a great week, a wonderful weekend, and we'll be back with another webinar next Tuesday. This is Scott Tomlinson signing off.